guys, I'm Karunya Rao and in Ideas for Profit, all eyes on Sumitomo Chemical India. After 1.5 years of one-way rally, market participants are turning a tad cautious given macro risk factors related to reversal of liquidity, inflation and a potential consecutive COVID wave. A time like this warrants separating the wheat from the chaff in the equity world in terms of differentiated business models, product range and management quality. And for chemical players, differentiating factor includes focus on new products which are functionally improved and environmentally less burdensome. And in this context, Sumitomo Chemical India garners attention given its focus on specialty products backed by R&D strength of Japanese parentage. Key near-term trigger to watch is the manufacturing of technical-grade active ingredient products for parent company Sumitomo Chemical Company. SCI is among the largest players in the Indian agrochemical space with a market share of about 13%. It has manufacturing facilities with more than 200 brands, 25 patents and more than 200 registrations. SCI has a strong distribution network with more than 14,000 distributors and over 40,000 retailers reaching over 1 million farmers. It is present both in specialty as well as generic space. It has diversified product portfolio with a presence across categories whether it's insecticides, herbicides, fungicides, plant growth regulators and animal care. Product portfolio is quite diversified clearly with top 10 products contributing less than 50% of the revenue. Specialty agrochemicals has been a key focus area for SCI since 2010. It competes with MNCs like Bayer and Monsanto in this space and has been investing on field trials and engagement with farmers and has scaled up the business to about 30% of the top line. Now, Sumitomo also aims to introduce 2 to 3 new specialty products every year to enhance share of the segment. Its generic business strengthened considerably with the acquisition of Excel Crop Care in FY19. Apart from that, the company also plans to introduce products in the fast-growing biopesticide space through Valent Biosciences. Valent, in fact, is known for its extensive portfolio of biorational products. Biorational products essentially are derived from biological origins and include biological pesticides, products used for crop stress management, enhanced physiological benefits and root growth management. To take advantage of low-cost manufacturing in India, parent SCC as well as group companies worldwide would source technicals from SCI. Parent SCC has shortlisted 5 technicals to be supplied by SCI. Currently, it supplies 1 technical to the parent company in small quantities. Therefore, SCC sourcing technicals mostly from Japan and the US as of now provides a huge growth opportunity for SCI. SCI also has potential opportunity to supply to other group companies as well. Meanwhile, it plans to invest about 100 to 110 crores for manufacturing 5 technicals that have to be supplied to parent in Japan. It's also aiming for a potential revenue of around 200 to 250 crore from sales of these 5 products to the parent company. SCI has a strong balance sheet with zero debt. The company has cash and cash equivalents worth 530 crores. Capex plans would be funded through internal accruals. Additionally, the cash flow is expected to remain strong with the company hoping to generate operating cash flow worth 900 to 1000 crores over the next 2 years. Given the comfortable cash position, SCI might look at inorganic opportunities to drive growth. The company has strong return ratios as well with ROE of close to 20% while ROCE is close to 30%. SCI benefits from continued new launches in the domestic market, including high-growth biopesticides as well as the opportunity to export technicals to group companies. It has taken 2 land parcels at the adjacent Bhavnagar plant, while 50 acres at the new Greenfield Dahej plant will take care of the growth prospects over the medium term. SCI has a strong R&D focused parentage as SCC spends about 8 to 9% of its revenue on R&D. Parent's technical know-how enables the company to introduce effective and technologically advanced products in the Indian market. This is also reflected in recent margin improvement, which is likely to sustain. SCI's management attributed margin improvement of 470 basis points in FY21 to better product mix, operational efficiency as well as realization of Excel Crop Care merger benefits. The company plans to focus on plant growth regulators and herbicides which have relatively better margins. It also aims to introduce high-margin specialty proprietary products in India to further enhance the product profile. Now coming to valuations. The stock is trading at about 44x its FY23 projected earnings. While it is at a premium to other agrochemical players, the higher multiples are justified given the strong growth prospects of the company.